There's a convergence pattern that has never happened before in economic history. Three separate crashes building simultaneously in the same system. And right now in 2025, the United States is sitting at the intersection of all three. A commercial real estate collapse with $1.5 trillion in distressed properties. A regional banking crisis with over 400 banks technically insolvent. And a Treasury market dysfunction with $7 trillion in unrealized losses. Within 12 to 24 months, these three crashes will trigger each other in sequence, creating a cascade failure that makes 2008 look contained. This convergence has never happened before because the conditions have never existed before. And here's what should terrify you. Economists know about all three crashes individually. They discuss them in private. They hedge their own portfolios. But publicly, they say nothing, because admitting all three are happening simultaneously means admitting the financial system is fundamentally broken. This is the story of three inevitable crashes building in real time, why each one alone would be catastrophic, and why the mathematical reality is that all three will trigger within months of each other. And it's happening faster than anyone wants to admit. Before we go through the three crashes, you need to understand what a convergent collapse actually looks like. Not in textbooks, in practice. Most financial crises come from a single point of failure. 1929 was a stock market crash. 1987 was a stock market crash. The savings and loan crisis was a banking crisis. 2008 was a housing and banking crisis. One domino falls. The system scrambles to contain it. Sometimes they succeed. Sometimes they don't. But convergent collapse is different. It's when three separate crises reach critical mass at the same time, and each one makes the others worse. The housing crash weakens banks. Weak banks can't buy government bonds. Government bonds sell off. Bond yields spike. Higher yields make real estate crash harder, which weakens banks more. It's a feedback loop with no exit. The three crashes building right now are: Crash 1. Commercial real estate. $1.5 trillion in distressed office buildings, malls, and retail spaces that will never recover their value. Loans coming due that can't be refinanced. Property values down 40 to 60% from peak. This crash is guaranteed. It's only a question of when banks acknowledge the losses. Crash 2. Regional banking crisis. Over 400 small and mid-sized banks sitting on $600 billion in unrealized losses from bonds they bought at low rates. When depositors demand their money, banks have to sell bonds at a loss. When they sell at a loss, they become insolvent. This crash is mathematical. Rising rates guarantee it. Crash 3. Treasury market dysfunction. $36 trillion in government debt. Interest costs hitting $1.2 trillion annually. Foreign buyers disappearing. Primary dealers struggling to absorb new issuance. When the Treasury market breaks, when the U.S. government can't sell its debt, everything collapses. This is the systemic crash, the one that ends the game. Each crash alone is containable. Maybe. But all three together create a convergence that breaks the financial system. Let me show you how each one is building toward critical mass. Let's start with commercial real estate. The crash everyone can see, but nobody wants to acknowledge. In 2019, commercial real estate in America was worth $20 trillion. Office buildings in Manhattan traded at $1,500 per square foot. Shopping malls were valued based on steady cash flow from retail tenants. Class A office space in San Francisco, Austin, Miami, all hitting all-time highs. Then COVID hit. But instead of collapsing immediately, the government response pumped money into the system. Low rates. Stimulus. CRE values actually went up in 2021. Office buildings in some markets hit new peaks even as they sat 40% vacant. The disconnect from reality was complete. Here's what makes this a guaranteed crash. Commercial real estate loans are typically 5 to 7-year terms. Properties bought or refinanced in 2019 to 2021 at 3 to 4% interest rates are now coming due. But today's rates are 7 to 8%, and the properties are worth 40 to 60% less. Example: $100 million Australian dollar office building bought in 2020 with $70 million loan at 3.5% interest. The loan comes due in 2025. The building is now worth $50 million, half the loan value. Nobody will refinance a $70 million loan on a $50 million property. The owner defaults. The bank takes the property. The bank now owns an asset worth $50 million, but has a $70 million loan on its books. $20 million loss. Multiply this by thousands of properties. $1.5 trillion in distressed commercial real estate loans coming due between 2024 and 2027. 2024, early defaults begin. Office vacancy rates in major cities hit 20 to 25%. Owners stop paying on buildings that will never recover value. Banks start extending loans, pretending everything's fine. 2025, the extend and pretend strategy fails. Too many loans coming due. Banks can't extend all of them. Major defaults on trophy properties. Blackstone defaults on a $1.2 billion office portfolio in January 2025. More coming. 2026 to 2027, cascade. As properties sell at 50 cents on the dollar, valuations across the entire sector collapse. Banks holding CRE loans see their asset values crater. Some become insolvent. And here's what people don't understand. This isn't like 2008, where housing could recover. Remote work is permanent. Companies have cut office space by 30 to 40% permanently. The demand isn't coming back. Ever. These buildings are worth 50 to 60% less than their loans. The crash is mathematical. The only question is when banks admit the losses. And when they're forced to admit them, crash too accelerates. Let's talk about the crash that already started in March 2023 but never finished. During COVID, banks were flooded with deposits. People got stimulus checks, businesses got PPP loans, money poured into checking accounts. Banks had too much cash. They needed to invest it somewhere to earn returns. So they bought U.S. Treasury bonds and mortgage-backed securities. Safe assets, backed by the government. Rated AAA. They bought long-term bonds at 1 to 2% yields. Billions and billions of safe government bonds. When interest rates were 1%, a 10-year Treasury bond was worth face value. $1,000 bond equals $1,000. But when rates went to 5%, that same bond became worth $750. Why? Because nobody wants a bond paying 1% when new bonds pay 5%. To sell it, you have to discount the price. Banks bought over $2 trillion in bonds at 1 to 2% rates. When rates hit 5%, those bonds lost 20 to 30% of their value. The banks still own them. They're still on the books at face value. But if they have to sell them, they realize a massive loss. This is called unrealized losses. As long as banks hold the bonds to maturity, the losses are theoretical. But if depositors demand their money, banks have to sell bonds to raise cash. When they sell, losses become real. When losses become real, banks become insolvent. March 2023, Silicon Valley Bank fails. They had $16 billion in unrealized losses on bonds. Depositors panicked and withdrew. SVB had to sell bonds at a loss. The losses made them insolvent. Bank run. Collapse in 48 hours. Signature Bank fails the same week. First Republic fails in May. All the same problem. Unrealized bond losses become realized when depositors flee. The government stepped in. FDIC guaranteed deposits. The Fed created emergency lending facilities. They stopped the immediate panic. But they didn't fix the underlying problem. Over 400 regional and community banks have unrealized losses exceeding 10% of their capital. Total unrealized losses across the banking sector. $600 billion according to the FDIC. These banks are technically solvent, as long as nobody withdraws money. But if depositors start pulling funds, if businesses move deposits to larger banks, the unrealized losses become real. And here's the convergence. When commercial real estate crashes, regional banks, who hold most of the CRE loans, take massive losses. CRE losses plus unrealized bond losses equals insolvency. Not for 5 banks, for hundreds. And here's what people don't understand. The 2023 banking crisis never ended. It was paused. The emergency lending facilities are temporary. The unrealized losses are still there. And when CRE crashes, those losses compound. Hundreds of banks will fail. Not might. Will. The FDIC has $128 billion in its insurance fund. The banking sector has $600 billion in unrealized losses plus hundreds of billions in coming CRE losses. The math doesn't work. The FDIC can't cover it. When crash 1 triggers crash 2, the government will have to choose: bail out hundreds of banks or let the regional banking system collapse. Now let's talk about the crash that ends everything. The Treasury market. For 30 years, the U.S. government has operated under a simple assumption. We can always borrow whatever we need. Treasury auctions always succeed. There's always demand for U.S. debt. The dollar is the reserve currency. Treasuries are the safe asset. We can borrow $2 trillion per year forever. That assumption is breaking. U.S. debt, $36 trillion. Annual deficits, $2 trillion. Interest costs, $1.2 trillion per year, more than defense spending. To fund the deficit and refinance maturing debt, the Treasury has to sell $10 to $12 trillion in bonds every year. Somebody has to buy them. For decades, the buyers were foreign central banks, China, Japan, oil exporters, U.S. banks, pension funds, and asset managers, the Federal Reserve. But the buyers are disappearing. China's Treasury holdings peaked at $1.3 trillion in 2013. Today, $775 billion. They've sold $500 billion. Japan has stopped buying. In 2024, foreign central banks were net sellers of treasuries for the first time in 20 years. Why? De-dollarization. BRICS alternatives. Geopolitical tensions. They don't want to hold dollars anymore. U.S. banks are sitting on $600 billion in unrealized bond losses. They're not buying more treasuries. They're trying to reduce exposure. When CRE crashes hit their balance sheets, they'll have to sell treasuries, not buy them. The Fed bought $5 trillion in treasuries during COVID. They expanded their balance sheet to $9 trillion. Then inflation hit. They had to reverse. They're now selling bonds, quantitative tightening. They can't go back to buying without reigniting inflation. Primary dealers, the big banks that are required to buy treasuries at auction, are hitting their limits. They already hold over $1 trillion in treasuries. They can't absorb much more without taking on excessive risk. 2024, treasury auctions start showing stress. Higher yields needed to clear auctions. Foreign participation drops to 20-year lows. But auctions still succeed, barely. 2025, a failed auction. Maybe not a complete failure, but one where yields spike 50 basis points to attract buyers. The market panics. If the U.S. government can't sell debt, everything breaks. 2026, convergence. CRE crash forces banks to sell treasuries to raise cash. Regional bank failures mean fewer treasury buyers. Foreign central banks continue selling. A major auction fails completely. Yields spike to 7%, 8%, 9% on 10-year bonds. When Treasury yields hit 8 to 9%, the U.S. government's interest costs double. $2.4 trillion per year just on interest. That's 40% of tax revenue. The debt spiral accelerates. More borrowing needed. Less demand for bonds. Higher yields required. Death spiral. And here's what people do and understand. The Treasury market is the foundation of the global financial system. If treasuries become risky, if auctions fail, everything built on top collapses. Corporate bonds, municipal bonds, mortgage rates, everything is priced off treasuries. When the Treasury market breaks, there is no backup system, no plan B. The entire dollar-based financial system ends. This isn't 2008 where the Fed could print money and buy assets. This is the Fed's asset. When treasuries crash, the Fed can't save them without destroying the dollar through hyperinflation. And here's what should keep you awake at night. All three crashes are building simultaneously, and each one triggers the others. Start with Crash 1, commercial real estate. $1.5 trillion in distressed properties. Defaults accelerate through 2025 to 2026. Banks take massive losses on CRE loans. Check. Crash 1 triggers Crash 2. Regional banks holding CRE loans become insolvent. They have to sell assets to raise capital. They sell treasury bonds. Those sales realize their unrealized losses. Hundreds of banks fail. The FDIC is overwhelmed. Bank run spread. Check. Crash 2 triggers Crash 3. Banks selling treasuries flood the market. At the same time, banks are no longer buying new treasuries. They're insolvent or struggling. Treasury auctions start failing. Yields spike. The U.S. government's interest costs explode. The debt spiral accelerates. Check. Crash 3 feeds back to Crash 1 and 2. Higher treasury yields mean higher interest rates everywhere. CRE crashes harder because refinancing becomes impossible even for good properties. More banks fail as higher rates destroy their bond portfolios further. The feedback loop is complete. Each crash is currently at critical mass. CRE, $1.5 trillion in distressed loans, coming due now. Banking, $600 billion in unrealized losses, waiting for a trigger. Treasuries, foreign demand collapsing, domestic buyers tapped out. The convergence hasn't happened yet, but the three crashes are all scheduled to hit within 12 to 24 months of each other. And when one goes, they all go. Since 2023, we've accelerated toward convergence. SVB failed, showing the banking crisis is real. Blackstone defaulted on major CRE, showing crash 1 is starting. Foreign Treasury demand hit 20-year lows, showing crash 3 is building. We're not slowly walking toward three separate problems. We're sprinting toward a simultaneous convergence. In 2008, we had one crash, housing and banking. It took $10 trillion in bailouts and money printing to contain. This time we have three crashes, each one larger, all hitting at once. The government can't bail out $1.5 trillion in CRE, $600 billion in banking losses, and a Treasury market crisis simultaneously. The math doesn't work. The money doesn't exist. When convergence hits, the system breaks. Not slowly. Suddenly. Three crashes are building. Each one is inevitable on its own. Together, they create a convergence that has never happened before in financial history. Economists know this. They discuss it in private. They hedge their own portfolios. They move money to safety. But publicly, they say nothing. Because admitting all three crashes are coming means admitting the financial system is fundamentally broken. And if the public realizes that, the panic starts immediately. Maybe we're wrong. Maybe CRE recovers. Maybe banks can hold bonds to maturity forever. Maybe Treasury auctions keep succeeding despite collapsing demand. Maybe all three crashes can be contained separately. But the math says otherwise. The timeline says otherwise. And history, which has never seen three crashes converge like this, says we're about to experience something unprecedented. The convergence is coming. 12 to 24 months. Three crashes. One system. And when they hit, the financial world we've known for 50 years ends.